Almost every country in the world today has a central bank. In fact, there are only 2 countries in the world that have their own currency and do not have a central bank, and those are Tuvalu with a population of just 9,500 people, and Kiribati with 132,000 people. Now, despite being such tiny counterexamples, they realistically also both generally default to using the Australian dollar for most serious transactions anyway. The reason that central banks have become a nearly universal feature of every economy on Earth is because they work. Especially in our highly integrated global economy with dozens of floating fiat currencies, they have become a check and balance on economic recklessness. They are an emergency backstop in times of crisis, a partially independent regulator on inflation and employment, and beyond that there are the slightly more boring aspects of central banks as institutions that handle a lot of the administration that goes into keeping a currency functional. These are all jobs that have become significantly more difficult in recent years as the world becomes more integrated, debts continue to balloon, and inequality undermines the tools that these banks have to work with. And of course, to make matters worse, all of these responsibilities have been called into question as the US government has tossed up the idea of scrapping the Fed altogether, something that's caught the attention of everybody from global bank executives to conspiracy theorists that think the whole show is run by lizard people. Now from the get-go, realistically, this is very unlikely to actually happen. The Fed is the most powerful financial institution on the planet, and unwinding its place in the global economy would be borderline impossible. But it's also not without precedent. Central banks have been abolished before, including in the USA, and what's more is that the actual effectiveness of these institutions has been called into question more and more as they not only have to tame their economies, but they are increasingly often at odds with their own governments to do so. With such powerful institutions acting in such unintuitive ways with so much of a consequence on our everyday lives, it's almost understandable that people just assume that something sinister is going on in these places. So, if for no other reason than to get a better idea of what these central banks actually do, could the US get rid of the Fed? What would that do to the global economy? And finally, what are the more immediate problems that central banks are facing? To understand what central banks like the Fed are supposed to do, one of the best places to start is with the historical problems that necessitated their formation. Now, to be completely honest, this video is already going to be quite long, so if you already have a good understanding of financial history, feel free to skip to this timestamp here. A very brief history of central banks is that they informally started with European banking houses set up by cities to manage their debts and issue coinage to facilitate easy trade. The first formal central banks were the Bank of England, established in 1694, and before that the Sveriges Riksbank of Sweden, which was established in 1688. This is the same institution that awards the Nobel Prize in Economics as a fun little side note. In these early days, they still hadn't quite grown into their role, but they were still operating as a bank for banks and for the government, as well as managing a universally recognised currency, which made commerce within these countries much smoother. The US actually had a similar kind of early central bank, starting all the way back in 1791. Alexander Hamilton awarded a charter to a bank that was founded partially by the government and a group of private investors to remove frictions in the financial system. It would also distribute and manage a universally recognised currency that people could trade freely with across all of the new United States, confident that private banks would accept these notes because the First Bank of America back in Washington guaranteed them. However, this first bank was abolished in 1811 because its charter was not renewed. But then it was brought back again in 1816 before it was once again abolished in 1836 because the president at the time, Andrew Jackson, did not like how much power the institution had, something that would become a common theme amongst a lot of central banks and presidents into the future. Now, the thing with these banks is that they were just regular banks with a profit motive and special privileges given to them by the government. This made it hard for them to balance the priorities of returns to their investors with doing what was in the best interest of the new nation, while also ensuring that they didn't anger lawmakers who could take away their charter of special privileges. They were compromised at best. Unfortunately, after they were abolished, things didn't get much better as basically every regional bank started issuing their own depository notes, which made trade difficult because there was no guarantee that one bank would accept another bank's notes, and with so many different pieces of paper circulating around, forgeries were rampant. Now, at this time, it was important to remember that the US dollar technically already existed, but there was no paper notes and the actual coinage was too limited to be used practically for day-to-day commerce, so private banks made up their own and people just accepted the numbers they wrote down on those pieces of paper. Realistically, it's not too dissimilar from today. If you really think about it, we don't carry around paper notes anymore. We have electronic bank accounts with numbers that a private banking institution writes down for us. We assume that the numbers in our bank accounts will play nicely with the numbers in other banks, and instead of being secured by designs that are hard to forge, it's secured by electronic systems that are hard to hack. But hold up a bank account and a phone and an old private paper bill, and it would be very hard to explain the difference to an alien. Either way, these issues all came to a head in 1907 with a run on these independent, over-leveraged and poorly regulated banks, which nearly crashed the entire financial system. A group of financiers led by JP Morgan acted as a lender of last resort to give these failing institutions enough cash to continue their operations, but this showed the clear need for a more formal centralised system to stop the same thing from happening again. This led to the formation of the Federal Reserve banking system of the United States in 1913. 20 years later, gold convertibility was suspended for citizens, and the paper US dollar as we know it today was truly born. At the time, this new institution only really had one responsibility: to avoid bank runs like what happened in 1907. It did this by being a place for private banks to deposit their cash and then lending money to any member bank if they saw a big spike in withdrawals that they didn't have enough cash on hand to fulfill. This would avoid a situation where a bank had to reject withdrawals, which would cause a panic on the entire system. Now, this admittedly oversimplified history lesson is important because throughout their different incarnations, they were all trying to do one thing: create a reliable and flexible medium of exchange, which meant distributing, protecting, and managing a currency. Now, some versions of a central bank were more successful than others, but this was still the end goal. Over time, as more and more countries adopted their own central banks, it became clear that by being a bank for banks, they could achieve other goals in the economy as well. They could control inflation, which was just a function of how much of their currency was needed for a given amount of goods and services, but they could also indirectly control employment, which by extension also meant economic growth. In the USA, these responsibilities were formalised in 1977 as the dual mandate to stabilise prices and maintain maximum employment. Most central banks around the world have similar responsibilities, usually listed on their website if you happen to be interested in looking up what your bank is formally working towards. So, how do they do this? Central banks are very powerful institutions, but they actually don't have that many tools at their disposal to achieve these goals. Unlike, say, the federal government of the USA, which can just go out and employ people through big projects or hiring at government agencies, the Fed can't just hire a whole bunch of people to achieve their goal of maximum employment. Instead, they have two levers to pull, and that's pretty much it. Of course, the first is interest rates. If inflation is too high, the Fed can raise its target rate, which means people can earn more by saving money and will pay more to borrow money. This means that people and businesses are more motivated to save and less encouraged to spend, which will lower aggregate demand in the economy, and if demand falls without a subsequent fall in supply, then prices will also naturally fall as well as businesses try to attract the few people still spending money through sales or generally more competitive prices. The opposite is also true. If interest rates are lowered, then people will end up spending less on repaying their debts, which means they'll have more money to spend on everything else, increasing aggregate demand, and again, assuming that supply stays stable, prices will rise as more money is chasing fewer goods. Broadly rising prices is just inflation. Now here's the thing though, regular people and businesses can't go and borrow money from the Fed or make deposits there. Only banks and governments can do that. So the Fed can only change the rate it gives out to other banks that keep money with them. This could be thought of as the interest that banks receive for keeping their money in a bank account for banks. Now, if for example the Fed is offering a 4% overnight cash rate, this is effectively the money that they can get risk-free, so if they're going to make loans, they're going to want a higher interest rate. This is just like if an average person could get 4% in their high-interest federally insured savings account, and they were presented with an even slightly risky investment opportunity that paid 3% interest. Well, of course, they wouldn't take it. This basically sets the floor on borrowing costs for private banks, which gets passed along to every other participant in the economy. So, to influence prices, it's a bit of a Rube Goldberg machine. The Fed adjusts its overnight rate to influence banks, to influence borrowing and lending, to influence demand, to influence prices. Interest rates are kind of like the brake pedal on the economy. If things are getting out of hand, they can be used to slow down inflation. However, in doing so, they will also slow down economic growth. Now, with that crude analogy, the accelerator would be open market operations. This is where the Fed will just directly intervene in the market, usually buying up government bonds, which to the average person is the lowest risk interest-bearing asset they can own. The most extreme version of open market operations is something called quantitative easing, where the Fed will create money and use it to pump liquidity into the market by buying government bonds, corporate bonds, mortgage-backed securities, and sometimes even shares and other equity. The goal is to get money out there in times of crisis, and then hopefully sell back these assets over time to take the extra money back out of circulation. Economists will often refer to this as the Fed's balance sheet, which is honestly a little bit confusing because it's not really like a balance sheet in the traditional business, because traditional businesses aren't allowed to bippity-boppity boop their own cash into existence to acquire these assets in the first place. One other quick but very important side note is that because the Fed gets to make money to buy assets, it usually runs a pretty significant profit on the interest it gets from things like government bonds. That money gets used to cover the bank's operating expenses like paying its staff and or perhaps renovating its offices, as a completely random example. After it does this, it actually pays out a modest dividend to its shareholders, more on who they are later, and then any money that's left over after that gets paid to the US Treasury, and before the last few years, that contributed tens of billions of dollars annually. Unfortunately for the Fed right now, it's actually running at a large loss. During COVID, it bought lots of bonds as a quantitative easing measure to get money out there into the economy, but those bonds were paying low interest at the time, and now that interest rates have risen again, they are paying banks a lot of money in overnight deposits, but they aren't earning much on the assets that they have acquired. This technically means that the Fed has been making a loss for the last 2 years. Now again, that doesn't really matter. It can make its own money, and any losses are just counted as more money it can take out of circulation in the following years. However, if one was, hypothetically, politically motivated to shake up management at the Federal Reserve, they could point out these massive financial losses, and to the vast majority of people, it would look like mismanagement. So, it's very important to remember that in reality, the Fed running at a loss doesn't really mean anything. However, it also doesn't mean that it and other central banks haven't had significant problems in recent years performing their intended role, and one of the biggest of those challenges is losing control of debt and inequality. Managing monetary policy is kind of like trying to stand a stick up on your hand. A very small stick is quite hard to work with, but a very large stick is also very hard to balance. For monetary policy to have an impact, people need to be doing some borrowing, but as household, corporate, and government debt has grown to almost unprecedented levels, it's become much harder to manage inflation with small changes that don't have massive impacts on these heavily indebted parties. This balancing act is made even harder by the fact that inflation really depends on what market is being targeted. Lower interest rates and quantitative easing led to high rates of inflation in consumer prices since COVID, which is an issue that most economies are still dealing with now, but more so than that, asset prices have grown significantly faster. Most of the extra cash pumped into the economy went to wealthier households which primarily purchase these assets rather than normal goods for consumption, driving up their prices. Now for things like stocks, rising prices are generally seen as a good thing, but there are other areas like real estate where this can have major adverse impacts on the economy. The Nobel Prize-winning economist Joseph Stiglitz started talking about this problem in particular. Real estate prices have already risen, so raising interest rates on things like commercial mortgages will mean that businesses need to make more money to cover their repayments or rents, which means that they will need to charge higher prices, which means inflation. The exact opposite of what raising rates was supposed to do in the first place. The Fed can make inflation as measured by the Consumer Price Index look better on paper by crushing demand in poorer, indebted households, but they have much less control over wealthier households that aren't dependent on borrowing to consume and will generally just use any extra cash to acquire more assets. Now, of course, inequality is nothing new. It's been growing consistently for almost the entire history of the Fed, but it has become a lot more extreme since the pandemic, largely because of central banks and their actions. Put simply, they pumped a lot of money into the system, which eventually settled with wealthy asset owners, and now they're desperately trying to suck it back out, but the only juice they can squeeze is poor people with debts to pay. Now, aside from the clear social problems that come along with ratcheting up inequality to Gilded Age levels, it also makes it really hard to control the economy because the Fed is really controlling 3 economies. One for rich people, one for regular people, and an increasingly large one for the government. Government spending as a portion of the total economy is now higher in most economies than it has been at any point in history, including the Second World War, with the exception of the UK. Governments have become an increasingly large employer, both directly and indirectly through continuous contracts. Now, the growing influence of governments by itself has made the role of banks increasingly difficult because they often end up fighting one another. For central banks to function effectively, they need some level of independence from the politicians in power. This is because people running on a 3 to 4 year election cycle naturally want to deliver good economic conditions right now, even if it comes at the expense of the economy a decade down the track. The most obvious example of this would be the Fed desperately trying to get inflation under control by raising interest rates and pulling money back out of the economy. If the government wanted to complement these efforts, it would conduct what is called contractionary fiscal policy, which is raising taxes and lowering government spending. This works to reduce inflation because it leaves less money in people's pockets. It would also go a long way to balancing out the problems of wealthy people dealing with monetary policy differently, because taxes can be fine-tuned based on income, or perhaps if the government's feeling really crazy, even wealth. The exact mechanisms, though, are academic anyway, because, of course, especially in the USA, the government is doing exactly the opposite. Spending has remained extremely high despite some symbolic cuts around the edges, and some of the biggest tax cuts in history have just been rolled out, on top of consistent cuts that have already been implemented over recent decades, which, to be completely fair, has been pretty consistent between both parties. Nobody wants to be the politician to rein in the fun. We are also doing what all economists do and assuming ceteris paribus on the supply side as well. Things like an ongoing trade war will of course impact how much stuff makes it onto shelves and put upwards pressure on price too. If monetary policy is like the brakes on a car, current fiscal policy is slamming on the accelerator and steering down the steepest hill they can find. On top of this, it's become pretty clear that there is a lot of pressure on the Fed to just play along and lower interest rates to really let things rip. With effectively two economic checks and balances going head to head with one another, the idea has been floated that maybe the government doesn't even need the Fed anymore. Now this is, technically, possible. There is nothing magical about the Federal Reserve that couldn't be done by a disciplined Treasury Department which absorbs its responsibilities. The problem is that discipline. Compromised central banks that can't make unpopular decisions have almost always ended in disaster because no politician wants to raise rates to intentionally slow down their own economy. We made an entire video 2 years ago about Turkey inducing hyperinflation in its own economy because the president insisted on keeping interest rates low and would fire any central bank leader who dared raise them. The belief was that the country would grow its way out of problems, but predictably it just ended in disaster that the country is still dealing with to this day. Now the good news is that the chairman of the Fed doesn't have absolute discretion over the bank anyway. Also, the Federal Reserve Bank is actually 12 banks, each with their own leadership, responsibilities and shareholders of sorts. Now the actual makeup of this strange command structure isn't really that important to the economic functions they're supposed to conduct, but it is very important for any would-be political shake-ups. So if you're interested in a nerdy analysis of the Fed's organisational structure, we've made an entire video about that over on our other channel Context Matters, and you should be able to click to that on your screen now. Thanks for watching, mate. Bye.